Hello, class. This is your favorite professor, Professor Phanor. And as we discussed prior, I'm going to give you a brief synopsis of accounting for income taxes, mainly focusing on the corporate level. All right, so let's start. We have something called deferred taxes, tax assets, and deferred tax liabilities. All right. The goals of financial accounting in general and tax accounting are not the same. GAAP, also known as Generally Accepted Accounting Principles, is a set of rules for preparing financial statements, which are essentially useful to investors and creditors. Remember, we're creating these financial statements for everyone else so that we can confirm that this is this organization can continue as a going concern. Right, so Congress, through the Internal Revenue Service, IRS, and its Internal Revenue Code, its Internal Revenue Code is basically just the laws of the Internal Revenue Service, the laws that we are governed by in order to create our tax returns. That's what the Revenue Code is. And it's primarily concerned with the raising public revenues in a socially acceptable manner. Right? So the job of the Internal Revenue Code is to generate more revenue for the United States. And hopefully we allocate it in a proper way that is socially acceptable to everyone. Right? A consequence of differences between GAAP and tax rules is that tax payments frequently occur in the years different from the revenues and expenses generated that cause the actual taxes. So the result is that financial statement and income tax expense usually do not equal the IRS calculation of income taxes payable. Therefore, the objective of accounting for income taxes is to recognize a deferred tax liability or deferred tax asset for the tax consequences of the amounts that will become taxable or deductible in future years as a result of these transactions that have already occurred. And we'll get into that a little bit later with some more examples that I can give you. All right, so the difference in the rules for computing pre-tax accounting income according to GAAP and taxable income, which is according to the IRS, often causes to be reported income in different tax years as stated earlier. For example, if income from selling properties on an installment basis is reported for financial accounting purposes in the year of sales, there may be a difference. All right, so I can give you a slight example of that. Let's see here. I have here an installment sale, so I just entered in some information. Let's say that I had an organization called Professor Phanor LLC. In the description of the property, I put building here, but it can be anywhere. It can be 70 Fifth Avenue, Jersey City, New Jersey 07036. Right. Well, actually, you wouldn't put here an address. Actually, I'm wrong here. The description. Oh, actually, a lot of organizations leave it like this. They probably put it as just the street, not the whole address in general. And I would put probably the month, well, the total date that I actually acquired the asset. And remember, you can probably see that on your statement, your HUD statement, when you actually acquired the property, and you're going to put the date that you actually sold it. So this installment sale of income is just referencing that you have sold the property and you're still receiving income on an installment basis. You haven't received everything. All right, so it's talking about the selling price, including all the mortgages and other debts. That's going to increase your capital account, as well as these mortgages are going to increase your capital account. All right. And then we're going to add in all the depreciation, so you should have the depreciation worksheets attached, or even if not attached, just if it's not attached, it should just be part of your worksheet, your working papers. Right? We have the contract price here. This is also something very important, the gross profit percentage. And we've gone through that through other class periods. Right? So we can see here that the installment type of sale can give us some temporary differences. Okay. In general, a temporary difference is going to originate in one period, and as we stated before, it's going to reverse in one or more future periods. When the temporary differences cause accounting income to be greater than taxable income, the result is in general going to be a future taxable amount and a deferred tax liability. Okay. Actually, let me give you an example of that. We have here Kent Land Management Company, right? So in 2013, Kent Land Management reported $140 million in pre-tax accounting income, which included $40 million from installment sales of property. The pre-tax income, as we see here for years 2014 and 2015, was $100 million each year. All right. For the tax return income from the installment sale method, it's going to be reported when it's actually collected, which would be this $10 million in 2014 and the $30 million in 2015. The company is essentially subject to the 40% tax rate, and notice that for each year, the pre-tax accounting income is not equal to the taxable income. Yet, the total for the 3-year period for both is $340 million. So what is it saying here is that some things are deferred. Some things have a certain type of difference, right? We have certain differences between certain year periods, but the end result is always going to be the same. We can say that last week when we spoke about depreciation, that no matter what depreciation method we use, whether it's straight line method, double declining balance method, some of the years digits method, units of production method, it didn't matter which method we actually utilized, they all came out to the same result at the end. So it's the same thing as this. Like the accrual method and the cash method may have some temporary differences between certain years. They may recognize or realize income and expenses in different types of ways. But guess what? The result is the same. The result is the same. And we can say this kind of connects to life in general. We have so many people that are reaching goals in so many different ways, right? They think that there's only one way. There isn't only one way to success and different types of successes. But with that being said, you may take a road and I may take another road, but we may still become successful, right? So this is the same type of effect when we're speaking about the temporary differences. We're going to have different types of ways to reaching a destination, but we're still going to reach the same destination. In this example, it will be the $340 million. Same type of result. Now there's different types of temporary differences. In general, temporary differences can result from either revenues and gains or expenses and losses, which are reported on the income statement and tax return at different times, as we stated before. The temporary differences in the purple boxes, let me see here. I need you to see some purple boxes. Let me see here. Actually, this slide isn't working correctly. Let me go on to this slide. Right. In this example, we can note that the deferred tax liabilities can arise from either a revenue being reported on the tax return after the income statement, or an expense being reported on the tax return before the income statement. Okay. What can we say about this? Let's read an example here. The court's temporary services reported pre-tax accounting income in 2013, 2014, 2015, and 2016 of $100 million. In 2013, an asset was acquired for $100 million. The asset is depreciated for financial reporting purposes over 4 years on a straight line basis and has no residual value. For tax purposes, the asset's cost is deducted by the Maxer's method, which is a modified accelerated cost recovery system, a system mandated by the IRS in reference to depreciation. Over 2013 to 2016, as follows: $33 million, $44 million, $15 million, and $8 million. No other depreciable assets were acquired. The enacted tax rate is 40% each year. Right? We have to note that although depreciation amounts are different in each year, the total depreciation for year 4 is $100 million for both methods. Also, we can notice from this is that although the amount of pre-tax accounting income and taxable income are different in each year, the total income for the 4th year period is $400 million. So it's the same thing as the prior example. Right? So this connects with also depreciation. Right? You can depreciate at different types of rates on the tax return in comparison to the financial statements, the income statement of the financial statement, based on possibly the accrual basis using the straight line method. But the end result is the same. Right? So we have accrual basis, we have cash basis. Remember, when we're talking about taxes in general, it's on the cash basis. Okay. Now, in comparison to permanent differences, we have the counterattack, which is the permanent differences. Permanent differences are created when income is included in both the taxable income or accounting income, but it will never be included in the computation of the other. Right? I think a good example of this is tax-free municipal bonds. Right? Because the tax-free municipal bonds will be included on the financial statements, but it will never be included on the taxable income. Right? Because these tax-free municipal bonds, hence the name tax-free, it can't be taxed. Right? So we will reference this revenue, well, we'll recognize this revenue on the financial statements, but we're not going to reference this revenue on the tax return because it won't be taxed. And I could give you an example of the exact form that we would actually use so we can see how can this really be. Right? On the N3 based on the corporation tax return, we have net income loss reconciliation for corporations. So how do we reference this, right? And actually, we can see that the M3, I used to look at the M3 a couple of years ago, and now we can see that it's kind of changing as far as its accounting standards used. We have GAAP, of course, generally accepted accounting principles, and then we have International Financial Reporting Standards, the IFRS. This wasn't here a couple of years ago. Now we can clearly see the transition that the world is making as far as accounting and trying to get us acclimated into one system of accounting through IFRS. And we have tax basis and statutory, which were there before. Okay. So we have here the reconciliation of net income loss per income statement of includable corporations with taxable income per tax return. We can see here's the temporary differences that they're referring to. and here's the permanent differences, right? So when we're trying to add our net income, our income or loss per the tax return on line D, it has to come up with the right amount. Let's give an example here. Let me give you an example. Interest income. Interest income based on our financial statements, income or loss per income statement, is possibly $5,000. Let's make pretend. It's $5,000. It's not a temporary difference. It's more of a permanent difference because now I'm just saying that we're referring to the municipal bonds, the municipal tax-free bonds. So we're going to back that amount out. The permanent difference is going to be, let me see here, negative $5,000. Right? So the net effect of this number right here, the income per the tax return, is 0. Right, let me put it bigger for you so you can see. So that's a clear example. On our financial statements, based on the accrual basis, $5,000 is not considered a temporary difference. It's more considered a permanent difference because we're going to back that out as a municipal bond. So that's our example here. And from that, we're going to have 0 taxable income. So as it says here on the top of the income loss per tax return, right? So we're netting at 0. Okay. Now, there's some tax considerations to take into account. Okay, hold on here. Okay. So, with this being said, to measure the deferred tax liability or asset, we're going to multiply the temporary difference by the currently enacted tax rate, right? So the example that we've been using is 40%. And that will be effective in the years of the temporary difference reverses. We're not going to base calculations on anticipated legislation that would alter the company's tax rate. So in general, we need to look at the current tax rate for that year by looking at the Internal Revenue Code. A conceptual case can be made that expected rate changes should be anticipated when measuring the deferred tax liability or asset. So we can do even more research to kind of gauge where the economy is going as far as increasing the tax rates through different publications that may have came out during that tax year. However, this is one of many examples of the frequent trade-offs between relevance and reliability. Okay? So in this case, FASB, the Financial Accounting Standards Board, sometimes chooses to favor reliability by waiting until an anticipated change actually is enacted into law before recognizing its tax consequences. What does this all mean? That we have to actually wait in order to possibly think about putting a law into place on our actual financial statement or tax return. Right? So the consideration that we should have are laws that are put in place for the future. We have something called net operating losses, and we should clearly understand something like this because it will make or break you as an accounting manager, and it will definitely benefit your organization if you know how to use it properly to your advantage. Right? A net operating loss is negative taxable income. So whenever you have a loss in an organization, you can either carry it forward or carry it backwards. Right? So this is actually legal. Tax laws permit the operating loss to be used to reduce the taxable income in other profitable years. Right? So what is this going to do? This is going to offset operating profits with operating losses. And from those operating profits or losses, a carryback is going to occur. And let's look at an example here. Well, this isn't clearly an example. What this is it's kind of giving us the methodology of how it works, meaning that the net operating loss may be first be applied against taxable income from previous 2 years. Unused net operating loss may be carried over for 20 years. So you can either go 2 years back, or you can go even 20 years forward. Okay? Let's look at an example here. Let's look at this example that I found on investinganswers.com. I thought this was a fairly good example for us to look at. They have a great definition here. It says a net operating loss is a negative profit for tax purposes. It usually occurs when a company's tax deductions exceed its taxable, making the company unprofitable. And we can see here how it works. Net operating losses can be used to reduce future tax payments. For example, let's assume company XYZ has taxable income of $1 million with tax deductions of $1.3 million. So as we can see here, there's going to be a $300,000 loss, right? $300,000 loss. Company XYZ will probably not have to pay taxes, okay, that year. You have the loss, and a loss times whatever tax rate we want to use, possibly times 40%, is nothing. It's zero, okay? But let's assume, as it states here in the second sentence, that company XYZ makes a lot more money and records $500,000 of taxable income, right? So remember, we have a loss here of $300,000. We can net those amounts, the amount of taxable income of $500,000 connected to that $300,000, and we can suggest that we're going to be taxed on $200,000 instead. Okay, so we can carry over these losses, and why does it matter? As it says here, net operating losses are important because they create future tax relief. So if you really want to help out your organization, and just as a CFO of your future organization, you need to find innovative tax strategies in order to save money, right? So you have to understand depreciation. You have to be able to understand net operating losses. Essentially, understanding tax is very vital. Okay. Deferred tax assets and liabilities are classified as current or non-current based on the classification of the related asset or the liability. A deferred tax asset that is not related to the specific asset or liability should be classified according to when the underlying temporary difference is expected or reversed. What does this mean? Is that every time that you're classifying your balance sheet, it should be classified in a certain type of way where you're able to understand the differences, the permanent differences, the temporary differences of the organization on your balance sheet. So we've talked so many times about balance sheet representation. Remember that the balance sheet, the income statement, the financial statements in general are for the public eye. They're for the external environment. And creating these items for the external environment, it should be in a way that they can actually understand, it's readable, and it's able to be communicated in a way that is conducive to their understanding. Right? So as accountants, we have to classify things correctly, not only so our external environment understands, but so that other accountants are able to understand exactly what we're attempting to illustrate. And few expense items in the income statement rival the size of the income tax expense line. And few are subject to the complexities and differing interpretations inherent in reporting income tax expense. I mean, as many of you can imagine, most companies strive to legitimately reduce their overall tax burden and to reduce or relay cash outflow in taxes. As we stated before, your job is to decrease the taxable income. Even without additional efforts to reduce taxes, most companies' tax returns will include many tax positions that are subject to multiple interpretations, right? So everyone, I mean, you can connect this to anything in general, right? Love, for instance. Love has different interpretations based on how you grew up, what religious belief that you have, just your external environment in general. We can look at the scriptures, for instance, the Bible or the Quran, whatever type of scriptures that you use for your spiritual guidance. Everyone's going to have a different interpretation. If everyone didn't have a different interpretation, we would all have the same religious beliefs, but we don't. So it's the same thing as tax laws. There's different beliefs, there's different interpretations to these laws for these tax positions. Right? So the position management takes with respect to an element of tax expense might differ from the position of the IRS or the tax court might take on the same item. Right? Despite good faith positions taken in preparing tax returns, those judgments may not ultimately prevail if challenged by the IRS. So the IRS may challenge our tax positions that we take, and there may be fines connected to it. Right? So just make sure that any position that you take, that you're very confident in the realization or the recognition of income or expenses at the time. The intra-period tax allocation. All right. First, we need to understand what is intra-period. Intra-period. I received this definition from accountingtools.com. I thought it was a good definition. All right. The intra-period tax allocation, as it says here, let me just put it a little bit bigger, is the allocation of income taxes to different parts of the results appearing in the income statement of a business so that line items are stated net of tax. So its main position is that it's net of tax. So the continuing operations are going to be presented net of tax. And also the discontinued operations, the extraordinary items, the prior period adjustments. Let's remind ourselves of what are discontinued operations, right? As it says here, let's see here. Discontinued operations in general are operations that are going to be disposed of. Right? As it says here, it's resulting elimination. The disposal transaction will result in the operations and cash flows of the component being eliminated from company operations. So discontinued operations can be an operation that is currently still flowing, but it has the thought process that in soon time to come that it will be discontinued, or it could be something that's already discontinued. Okay? Let's remind ourselves of what are extraordinary items. Okay? Here are some examples of some extraordinary items. GAAP specifically states that write-offs, write-downs, gains or losses on the following items are not to be treated as extraordinary items. All right. So let's look at some examples of extraordinary items. Okay. As it says here, this is some good terminology here. The reporting of an extraordinary item should be an extremely rare event. So these rare events, as I've noted with other students, are hurricanes. Right? Any natural disaster would be an extraordinary event. Right? An earthquake. And what we need to understand about extraordinary events is that if there's a loss, we can write down the loss. But if there's a gain, possibly we shouldn't write down the gain. Why? Because GAAP says that we cannot write a gain. If it's a loss, which makes absolute sense, if it's a loss, we're attempting to use a conservative view. And that conservative view is that we are more likely to have a loss than a gain. Okay? So I gave you a brief overview of accounting for income taxes. And what we can say about this accounting for income taxes is that as a CEO of an organization, as a future CFO of your organization, you should be able to understand multiple aspects of your business, not just the financial reporting standards. You should understand the tax implications so that your business will be able to continue as a going concern as soon as possible. Right? We will discuss even more in class, so you can collect your questions. You can email me, and I'll see you in class next time. Thanks a lot.